A major cover-up at the big banks. I'm your host, Steve Van Metre, and thanks for joining me today. And I can't believe the big banks are doing this. The question is, why? Let's go to Bloomberg, where we picked today's story up, and see if we can find the answer. Mortgage market upheaval spurs $17 billion in paper losses for banks, as unreal losses will hinder banks' efforts to boost capital. Now, I want to put this in context because we just had the bank earnings not too long ago, and we didn't hear anything about this, and that's what is shocking. Let's continue on. While rising rates buoy revenue for the country's largest banks, in the short term, they also force them to write down the value of assets they hold on their balance sheet, exacerbating a capital squeeze that's prompted most of them to halt buybacks. At Wells Fargo, it was an additional $2.4 billion in unrealized losses on mortgage-backed securities and other bonds that weighed on shareholder equity in the third quarter. Wells Fargo's three biggest rivals took a similar hit. On mortgage-backed securities alone, the four banks' unrealized losses have climbed to $17 billion based on company filings. Now, the question is, why wasn't this front and center in their earnings reports? Well, there's a simple reason why. They swept it under the rug. The unrealized losses don't appear on the firm's income statements, but under accounting rules. Now, again, here we hear this thing, accounting rules. Now, when was the last time we ran into accounting rule problems? Well, of course, that was back during the great financial crisis, when, of course, the government had to suspend and change the accounting rules to keep the banks solvent. And now we're seeing the banks doing the same trick, perhaps in a different way. So they still end up hitting the bank's balance sheet, affecting the so-called accumulated other comprehensive income, or AOCI. There, the country's four largest banks, JP Morgan, Citigroup, Bank of America, and Wells Fargo, reported a $16 billion drop in their accumulated other comprehensive income for the third quarter. Get this, to a negative $102 billion. Now, that is staggering. If that was actually out in the public, can you imagine what people would be thinking about the banks? As company filings show, because swings in the AOCI affect shareholder equity, the drop in AOCI is weighed on key capital ratios. The write-downs come at a tough time for banks, which are trying to hoard capital to meet new higher regulatory requirements. Now, if your question is, what is this capital they're hoarding? Well, it's simple. Is a bank risks its capital when it lends. So if a loan goes into delinquency or default and the bank has to cover the losses, they need capital to cover that. So now they're facing having to raise capital, and that's another factor here against these big potential losses. They're just one of a bevy of headwinds weighing on capital ratios. Others include new accounting rules that say banks must set aside even more in reserves as a result of rising inflation that's threatening the overall economic outlook. And with the markets on edge over the Federal Reserve's rate hikes, banks have also been battling back an increase in risk-weighted assets, which are used to determine minimum capital levels. And many firms have moved billions of these assets into their so-called held-to-maturity portfolios in order to boost capital. Now, if you're trying to figure out what's going on here, it's because when interest rates go up, the value of these mortgage bonds go down, and that's what's hitting the bank's balance sheet. Now, they have to do what's called mark-to-market, meaning they have to account for the positive or negative appreciation of these bonds on their balance sheet. So how do you kind of dust this under the covers, so to speak? Well, it's simple. You move it to what's called your hold to maturity bucket. Now, this is much like the Fed's balance sheet, because we know the Fed doesn't account for gains or losses in their portfolio. Well, the banks can escape that too. So if they move a bond into their hold to maturity bucket, it means not only do they have to hold it to maturity, but they no longer have to account for the fluctuations. So you're seeing the banks make this move, but they're also doing something else that we'll get to in a moment, which somewhat perplexing is they're selling these things at a loss. The value of such security has surged to $802 billion from $495 billion at the start of the pandemic, as the four largest banks look to cover up these losses. For bonds in that pile, the recent softening of the mortgage and broader markets, again, won't affect capital ratios, so you can see what they're doing here is they're trying to cover up those losses. Still, the country's four biggest banks are sitting on $157 billion of mortgage-backed securities they've marked as available for sale, and paper loss on those assets have soared in recent quarters, hindering efforts to boost capitals. So this is one of the things that doesn't maybe make sense on front end of this, is why are the banks willing to sell these mortgage-backed securities and take a loss? Is there a reason for it? And let's dig deeper here to see if we can figure out what's going on. Because back in October, they were held $2.914 trillion of mortgage-backed securities on their balance sheet. This according to the assets and liabilities of commercial banks. This is put out by the Fed every Friday after market close. They've whittled that down to still $2.757 trillion. So they still hold a lot, and yet they're selling a piece of them at a loss. The question is why, and what does this mean for interest rates? Because most people would look at this and say, look, if the banks are dumping mortgage-backed securities, that means interest rates must go up. It's simple, right? The value of the bond goes down because they're dumping them. Interest rates go higher. But actually, the opposite actually is happening. If we go back now to 2010 and 11 and 12, we can see here that these are securities held outright, the mortgage-backed securities at the commercial banks. And you can see the banks were drawing down their holdings. And lo and behold, we put the 30-year fixed mortgage rate in red, and you see the rates actually trended lower. And it wasn't until the bank started accumulating mortgage-backed securities that we see the rates went back up and then stabilized. And then going again back here in 2018, the banks are cutting their mortgage-backed holdings in a falling market. And so this is what's sort of perplexing here, is because if rates are headed lower, why are the banks so eager to get rid of these bonds? It doesn't make sense. So right now, investors have to look at this and say, look, rates must go higher. But notably, again, banks are starting to shed these, telling us that rates should head lower. And indeed they are, as mortgage rates plunge in the largest weekly drop since 1981. Investors saw last week's lower than expected CPI data as an indication that the Federal Reserve may make smaller interest rate hikes in the months ahead. And of course, we know that long-term interest rates are a function of growth and inflation expectations. The market, the stock market being the biggest proxy of growth, still heading upward now and looking fairly strong, at least in the short term. But the Fed's perspective now, the market is saying, look, you're going to be cutting rates, at least pausing in the near term and perhaps cutting rates. And that means inflation expectations go down. And that means long rates should also fall. Again, the banks should be keyed on this. Again, kind of leaving us the question of why are they in an eager rush to get rid of these things at a loss? While the Fed does not set interest rates borrowers pay on mortgages directly, its actions influence them, as mortgage rates tend to track the 10-year Treasury yield. As investors see or anticipate rate hikes, they make moves which send yields higher and mortgage rates rise, giving us the impression that they should fall. And so let's take a look here at the yield curve, but we're going to look at a different one than we've looked at in the past. This is the 10-year 1-month Treasury yield. And what we're going to see here in blue, and this is staggering, is that 10-year yields are now less than 1-month yields. That's right. You can get a higher yield holding your money in a 1-month Treasury bill than you can in a 10-year Treasury note. And that tells us something about the interest rate market, and the bond market here is telling us that rates are likely to fall, again, adding to the conundrum of why the banks are selling here. Now, notably, we can look at this 10-year 1-month yield curve. You see it's inverted when it's below the black line, and I've got 30-year fixed mortgage rates in red. And notably, when we see these inversions and then a rise in the yield curve, which indicates yields are falling, we can see again mortgage rates head lower. We see it again back in 2019. We see an inversion here and a steepening, followed by, of course, falling mortgage rates. And again, we see it happen here. Now, the banks have to know this, which would suggest that they must believe that rates are going to fall. So if they're in an eager rush to unload these, why would they? They would want to accumulate them and take advantage of falling rates. But perhaps there's another reason they want to unload these, and that's where we get to the real story. As mortgage rates could tank home prices by 20%, according to a Fed study. House prices adjusted for inflation soared during the pandemic by the most since the 1970s, by analysis from the Dallas Fed economists. A pessimistic scenario where prices now retreat by 15 to 20% could subtract 0.5% to 0.7% from inflation-adjusted consumer spending, which is exactly what the Fed wants. Remember, they're trying to push back aggregate demand. They're trying to slow demand. Well, slowing the housing market, bringing prices down would certainly accomplish that, along with probably a deep and painful recession, but nevertheless. Such a negative wealth effect on aggregate demand would further restrain housing demand, deepening the price correction and setting in motion a negative feedback loop. Mortgage debt service payments as a share of personal disposable income was forecast to top 6% by the end of the third quarter, up from 3.9% in the prior months. So what are we starting to get at is perhaps the real story that the banks are worried about. I think their concern now is, what if prices do fall and they're stuck on these bonds that they then can't sell? Now they're forced to hold them, and now they have assets that are not performing because people either maybe are not paying, they might default, they enter delinquency because the value of their homes fell. And what did the banks learn during the last financial crisis? Is that when home values fall, people stop paying. And so now we see the motivation of the banks, because what else did we see in the great financial crisis? The government ran to their rescue. Now the question is, do you think the government will bail out the banks again, or will they let them fall on their sword? Let's keep digging. As home sales fell for the 9th straight month in October, as higher mortgage rates scared off potential buyers. Sales of previously owned homes dropped 5.9% from September to October, according to the National Association of Realtors. That is the slowest pace since December 2011, with the exception of the very brief drop at the beginning of the pandemic. The October reading put sales at a seasonally adjusted annualized pace of 4.43 million units, shockingly 28.4% lower year over year. And even as sales slow, supply remains stubbornly low. There were just 1.22 million homes for sale at the end of October. That's a 3.3 month supply. Those of you in the know in the real estate industry say that that is actually not very many homes for sale. It's considered to be a balanced market when there's 6 months supply. So you get this notion that the market is somewhat tight, but we could see home prices falling. I think that's what the banks are really afraid of. And the median price of an existing home sold in October was just under $380,000, an increase of 6.6% from a year ago. The price gains, however, are shrinking. Again, red flag for the bank, as a seasonal drop in home prices this year appears to be much deeper than usual. And we have this case now. We'll go back to that same 10-year 1-month yield curve held in red against the home price index. And what do we see when that curve steepens? Home prices come down. Now, we didn't see it before. Why is that? You might wonder, is there an anomaly here? And yes, it is. It is the Fed. Remember, they were doing QE back then to bring rates back down. That helped the housing market. And I think those days perhaps are numbered now, as we know the Fed is unlikely to race back into easing until things are really bad. But now it's clear. Why do the banks not want you to know about this? Why are they trying to offload these mortgage-backed securities? They're afraid of getting stuck with them when housing prices fall and people stop making payments. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.